Welcome back to the channel. If you're new here, in my recent videos I've been outlining some of the key principles mainly from Peter Lynch's book One Up on Wall Street, and we're talking about how to invest like Peter Lynch and just some overall strategies that are great no matter if you're a new investor or a seasoned veteran. These principles are great information that's directly applicable for everyone and could even be a great refresher for you when you get tempted to make some investments you probably shouldn't. So I'll link the other parts in the description below. This is going to be part 3 and we're going to be talking all about picking winners today. When you're looking for things to invest in, the best place to look is close to home, whether that's in your own house, products that you have, products you see in the mall, or these days that's not really a thing, maybe in e-commerce, what's always out of stock or what, consumers can't wait to get their hands on, what's always sold out. Think, companies like Apple, the iPhone comes out every year, they make one little tweak and people lose their minds. They sell out immediately. Think of a company like AMD. If we take a quick look at their website, you see that all of these chips are sold out. A good problem to have for the company. So when you're looking for things to invest in, start close to home. Invest in things that you actually know about, that you can understand for yourself. Now, with that being said, don't buy a stock just because a product is popular. You'd probably find a ton of Johnson & Johnson products throughout your house, but that doesn't mean you should automatically buy the stock. Only use this as a starting point for your investigation. But for example, a company like Procter & Gamble may make Pampers, and you think that's a great product, no one else makes it, but at the end of the day, Procter & Gamble is such a huge, massive company, and this small section of the business only drives a small portion of their revenue because it is such a vast company. So they could sell out of this one product and it's not going to have a huge impact on the company and or the stock price. So find out what the effect a product will have on a company's bottom line, how much of their business comes from this product. Now, generally speaking, Lynch likes to categorize stocks in 6 different categories. You have 1, your slow growers, number 2, your stalwarts, 3, fast growers, 4, cyclicals, 5, asset plays, and 6, turnarounds. So they're pretty self-explanatory, but think about your slow growers and your stalwarts are big companies that aren't growing very quick, like Procter & Gamble, I mentioned, Johnson & Johnson, companies like that have been around a long time. They're only going to grow a few percent a year. Fast growers would be companies like your Tesla. Cyclicals could be the auto industry or the airlines, companies that tend to do well for a string of years, but then are followed up with a string of bad years because there's just so many variables affecting it. Then you've got your asset plays, which is a little harder now, I think, to find, and that would just be finding companies that are very undervalued because people don't realize what their assets are worth. So you could use the example of a railroad company that owns, a ton of different acres throughout the country. But with, so much information being at our fingertips these days, it's definitely much more difficult to find asset plays, I think. And especially, technology advancing so quickly, something may be worth something on paper, but when you try and go to sell it, you may not be able to always get that. So be careful with asset plays. And then, of course, you've got your turnaround plays. I think of a company like IBM that has not performed well the last few years, but I think they are poised. They're at a crossroads right here where they can make a major turnaround. So your slow growers, your stalwarts, companies like J&J, they are great hedges during volatile times. And as we've seen, while other more speculative plays are getting crushed, these slow and steady stocks hold up pretty well when the sky is falling. Think of your, 3M, companies like that. Bristol Myers, Kellogg, and they all pay dividends as well. So they give you consistent cash flow. People during hard times and recessions may not be taking trips or buying new cars, but they're always going to need their cereal, their dog food. Just think of the staple items. Now, regarding fast-growing companies, I found this to be very interesting because you would probably think the opposite. Lynch says that a fast-growing company does not necessarily have to be in a fast-growing industry. When you're in a fast-growing industry, there's so much competition, and I like the quote Lynch uses is that in business, imitation is the sincerest form of battery. If you make a hot new product, and let's look at the electric vehicle space as an example, once one person does it successfully, everyone's going to try and mimic it, and now all of a sudden you have so many smart people who are starting companies, trying to make their own, electric vehicles, and what ends up happening is someone out there is going to find a better way to do it or a cheaper way, and it just is a race to the bottom. It means that everyone's profits if they had any, are going to decrease because there's just too much competition. So while the industry itself may do very well, think of your MJ space or your sports betting companies as well. I think you could apply this to. While we know that cannabis has been legalized in the US, so you'd think the cannabis companies would prosper, but it's not necessarily true because there's going to be too much supply and not enough demand for all of these companies to flourish. Yes, a couple may survive, but that means you now not only need to pick the key industry, but also the one or two companies that go all the way, which is very, very difficult. The odds are stacked against you, and the majority of these companies will fail. So how should you analyze a fast grower? Look at their balance sheets. You want to see that they have good, cash and assets to debt ratios and substantial profits. The trick is to figuring out when they'll stop growing and how much you should pay for that growth. When you're looking at turnarounds, a lot of the time they try to restructure to maximize shareholder value, and that's exactly what IBM is doing right now. In a restructure, a company usually tries to rid itself of certain unprofitable subsidiaries that it should have probably never acquired in the first place so that the company can get back to growing in those segments that are doing well and are promising for the future. Lynch, I love this term, what many call diversification, Lynch refers to as diversification. Companies that have no business making these acquisitions of whether it's unrelated businesses or businesses that they overpay for and it never really pans out, it can really send a great company that's thriving into a downward spiral because they take on so much debt and it never, a lot of the time it doesn't work out. They overpay for the company. They may not make as much profit from it as they anticipated. Then maybe a few years down the line, they have to sell the company for a fraction of what they paid for it. It just creates a big mess a lot of the time. So when you're looking at stocks, you want to first put them in categories and ask yourself, what are you looking for and what are your expectations? Basing your strategies on, generic formulas like sell when you're up 50% or sell when you double your money or, you should sell if it drops 10% are all folly. There's no point in treating a young growing company, let's say, as a slow grower and selling at a 50% gain when it could very well achieve a 1,000% gain. I use Tesla as the example. If you sold Tesla a year or two back, when you were up 100%, you missed out on the next 1,000% gain. So you really sell yourself short. At the same time, if a company's stock price has already doubled and the fundamentals are not looking great, they're taking on lots of debt, and the future's not as promising, the story, the reason why you purchased the company to begin with, it's just not looking the same, then you shouldn't hold on to it. So you shouldn't always hold on to it. You have to use your judgment. But putting stocks in categories is the first step to developing that story. So those 6 categories, remember, are your fast growers, your slow growers, stalwarts, cyclicals, asset plays, and turnarounds. So we're going to talk more about this. Stay tuned and make sure you check out the last couple videos if you missed them and look out for the next one. We're going to go into further depth on this and picking the perfect stock as well as stocks you should avoid. If you enjoyed the video today, please don't forget to like and subscribe. It really helps out the channel. So stay tuned and I'll see you next time.